Taxes in America can be complex. They involve many levels of government: federal, state, and local. Here's an overview of how taxes work. Federal taxes. These are taxes paid to the U.S. federal government. The main types of federal taxes include income tax. This is a tax on personal and business income. The rate is progressive. It rises as the income of an individual or a business rises. For individuals, the U.S. tax system for individuals has brackets and rates. They go up as income goes up. Here are some specifics. Tax brackets. As of the latest tax year, 7 federal tax brackets range from 10% to 37%. The bracket into which an individual falls depends on their taxable income and filing status. For example, single, married, filing jointly, etc. Standard deduction. Most taxpayers can reduce their taxable income using the standard deduction. Taxpayers can deduct a set amount from their income before the IRS calculates taxes. The amount varies depending on your filing status and adjusts annually for inflation. Itemized deductions. Taxpayers can choose to itemize deductions if the total exceeds the standard deduction. These include mortgage interest, state and local taxes, and medical expenses. They must exceed a certain threshold. You can also deduct charitable contributions. Tax credits. These benefits directly reduce the amount of tax owed. They can be refundable or non-refundable. Examples include the Earned Income Tax Credit, Child Tax Credit, and Education Credits. The last of these is the American Opportunity Tax Credit for businesses, corporations. For corporations, the federal income tax situation is different. Flat corporate rate. As of 2021, the corporate income tax rate is a flat 21%. It decreased from a high of 35%. The Tax Cuts and Jobs Act of 2017 did this. It aimed to make the U.S. corporate tax system more competitive globally. Deductions and credits. Corporations can deduct business expenses. These include salaries, supplies, and depreciation. They can also deduct other costs of running a business. They also have access to various business tax credits that can reduce their tax burden. Tax filing and adjustments. Both individuals and corporations must file annual tax returns with the IRS. Filing deadlines. Individuals usually must file returns by April 15th each year. For corporations, the deadline varies by their fiscal year end. Adjustments for inflation. The IRS adjusts many figures for inflation each year. These include tax brackets, standard deductions, and phase-outs for certain credits and deductions. Planning and compliance. Tax planning is crucial for both people and businesses. It reduces their tax liability legally. This involves strategic use of deductions and credits. Taxpayers need to stay informed about changes in tax law. This helps them make the best use of available deductions and credits. Tax advisors and software. Many people and businesses rely on tax advisors or software. They use them to navigate complex tax rules, follow them, and improve their tax situations. Payroll taxes. The employer deducts these taxes from the employee's paycheck. They fund Social Security and Medicare. Social Security taxes are part of the FICA, Federal Insurance Contributions Act. They fund the Social Security program. It provides retirement, disability, and survivor benefits to workers and their families. Here are more details. Tax rate. The employer and the employee contribute 6.2% of the employee's earnings. This applies to earnings up to the wage-based limit. Annually, they adjust the limit for inflation. For example, in 2023, this limit is $160,200. Wage-based limit. This is the maximum amount of earned income the tax applies to. Earnings above this limit are not subject to Social Security taxes. Medicare taxes. Medicare taxes fund the Medicare program. It mainly provides health insurance for Americans age 65 and older. It also covers some younger people with disabilities. These disabilities are as defined by the Social Security Administration. Details include tax rate. The standard Medicare tax rate is 1.45%. It applies to all earnings without a cap and is the same for employers and employees. Additional Medicare tax. High-income earners must pay an extra Medicare tax of 0.9%. It applies to individual incomes over $200,000 or $250,000 for married couples. Collection and compliance, withholding and payment. Employers must withhold these taxes from their employees' wages. They must then pay the taxes and their contributions. They report these taxes using IRS Form 941. It is the employer's quarterly federal tax return. Self-employment. Self-employed people pay the employer and employee portions of FICA taxes. The Self-Employment Contributions Act, SECA, taxes refer to these taxes. They use Schedule SE to report their earnings. They use it to calculate their payroll tax when filing their tax return. Impact on taxpayers' benefits. Entitlement, paying Social Security and Medicare taxes, gives workers credit. This credit goes toward their future eligibility for benefits from these programs. The number of credits for eligibility depends on the type of benefit, but it usually takes 10 years of work to qualify for Social Security. No withholding cap for Medicare. Unlike Social Security taxes, there is no upper income limit for Medicare taxes. All wages face Medicare taxes, which ensures that higher earners pay more. Importance of compliance penalties. Employers who fail to withhold or pay FICA taxes may face heavy fines and interest. Employers must comply with these taxes, and avoiding penalties is crucial. At year's end, employers must match their tax filings with the actual taxes withheld and paid. Form W-2 details the amount of taxes withheld from each employee's wages. Corporate taxes. Taxes on the profits of corporations. 1. Flat corporate tax rate. Before 2018, the U.S. had a graduated corporate tax rate. The rate increased with income. However, the 2017 reform simplified this into a flat tax rate, 21% flat rate. All C corporations now pay a flat tax rate of 21% on their profits. This change was intended to make the U.S. more competitive. It did so by lowering the corporate tax burden, which was once among the highest in developed nations. 2. Deductions for businesses. Corporations can cut their taxable income with deductions. These are expenses needed and normal for business. Some of the key deductions include cost of goods sold. COGS is the cost of items sold during the year. It can include the cost of making or buying them. Business expenses. Ordinary and necessary expenses incurred in running a business are deductible. This includes rent, utilities, salaries, and benefits for employees. Depreciation allows businesses to deduct the cost of items over their useful lives. It recognizes the wear and tear on machinery, buildings, and vehicles. Interest on business loans is usually deductible. This reduces the cost of borrowing for businesses. Tax credits and incentives. Corporations can benefit from deductions. They can also get various tax credits. Credits directly cut the tax owed rather than just income. Some common credits include research and development, R&D. International considerations. The 2017 tax reform also included rules for the foreign operations of U.S. corporations. Global Intangible Low-Taxed Income, GILTI. The U.S. taxes corporations on income they earn from their foreign subsidiaries. This aims to stop them from shifting profits to low-tax countries. Foreign-derived intangible income, FDII. This provision offers a lower tax rate on some income from foreign sources. It aims to encourage companies to keep and create intellectual property in the US 5. Compliance and reporting corporations must file their federal taxes annually using Form 11 to 20. Keeping accurate records and understanding tax rules is crucial. The IRS closely checks corporate tax returns. Impact of flat rate. The flat rate simplifies tax planning for corporations, but it also removes the progressive aspect of the tax system. In it, larger, more profitable companies pay a higher rate. The flat rate aims to be fair to all corporations, but it has led to debates about its impact on income inequality and government revenue. Excise taxes. Taxes on specific goods like gasoline, alcohol, and tobacco. Two main ways exist for levying excise taxes. The federal excise tax on gasoline helps fund highway and transportation projects. In recent years, it has typically been around $0.184 per gallon. Alcohol. The taxes vary by the type of alcohol, beer, wine, or spirits. They also vary by their volume and sometimes their alcohol content. Taxes on cigarettes and other tobacco products are high. They aim to discourage smoking and to pay for health costs from tobacco. The federal excise tax on cigarettes is $1.01 per pack. Firearms. Federal excise taxes on firearms and ammunition help fund wildlife conservation efforts. The tax rate is 10% or 11% of the sales price, depending on the type of firearm. State taxes. Each state in the U.S. has its tax system and can levy various types of taxes, including state income tax. Not all states have this, and those that do may have different rates and brackets. State income taxes show considerable variation across the U.S., both in terms of presence and rate structures. No tax states. 9 states do not impose a state income tax. Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Most recently, New Hampshire joined. It only taxes interest and dividends. High-tax states. At the other end of the spectrum, states like California and New York have high-income tax rates across multiple brackets. For example, California's top marginal tax rate is one of the highest in the nation. This variability can influence individual and business decisions. It can affect where to live and operate, impacting job markets, housing prices, and the economy in a state. The method of calculating income tax also varies by state. Progressive tax systems. States like California, New York, and Minnesota have progressive tax systems. The tax rate rises as income rises. These systems aim to ensure fairness. They tax higher incomes at higher rates. State income tax systems offer many deductions and credits. They are like the federal tax system. These can cut the tax you owe. Standard and itemized deductions. States may allow standard or itemized deductions, which are similar to federal deductions. These can be for mortgage interest, state taxes, or charitable contributions. Some states require conformity to federal itemized deduction choices, while others do not. Sales tax. Stores charge it when you buy things. The rate varies by state. Sometimes there are extra local taxes. The retailer collects sales tax at the time of the final sale to the consumer. The business bears the burden of managing the collection and remittance of the tax. In addition to state sales tax, many local jurisdictions impose their own sales taxes. These taxes can greatly affect the total tax rate. The structure of sales tax has several implications. Regressivity. Sales taxes are generally considered regressive. They take a larger percentage of income from the poor. It is more than they take from the rich. This is because they apply uniformly, regardless of the purchaser's income. Property tax. Homeowners pay it based on property value. It mainly funds local services. Property taxes are a key revenue source for local governments. These include counties, cities, school districts, and special districts. Many states provide homestead exemptions. They reduce the taxable value of homeowners' main homes. This offers relief to homeowners. Administering property taxes is hard. It includes ensuring fair assessments. It also involves managing appeals from property owners. And it means integrating exemptions and relief programs well. The U.S. tax system uses both pay-as-you-go and self-assessment principles. Taxpayers pay taxes as they earn or receive income. They must self-report all income and deductions truthfully.